Dear Ben Felix, Mr. Rip here. I know you are watching. Your latest video, which I assume it's extracted from the Rational Reminder podcast episode 201. Where is it? Which is called The Relevance of Dividend Irrelevance, when I assume is extracted from this. It's lacking subtitles or closed captions. But anyway, I'm sure my community is able to understand your clear voice, your clear tone of voice. Maybe my English will be more of a limitation in our communication. Let's get started. So this video is called The Relevance of Dividend Irrelevance. Ben Felix has already published several videos. Ben Felix CSI Investing. He has published several videos about dividend irrelevance, like the relevance of dividend growth investing. Those two videos, they're pretty famous about the relevance of dividends. The most famous one is the relevance of dividends, published almost 3 years ago, with only 250,000 views. And then dividend growth investing. This one is about still about dividends, but not high yield, but dividend growth, which is another strategy of investing only in companies who increase dividends over time. So this video, called The Relevance of Dividends, has been very impactful in my modeling of how a company who issues dividend is essentially indistinguishable from another company who doesn't. So the fact that a company issues dividends should be in itself not a deciding factor for you to invest in that company. Having said that, but he also says that there is a kind of a correlation between issuing nice dividends, like high dividend, and the value factor, which is a factor that studies show, Fama in French, that it has delivered highest performance in the last 100 years, not in the last 15. Yeah, we know that growth outperformed value, and that's it. This latest video, thanks Ben. I know you're watching. Ben. Ciao Ben. Il maestro Serpentieri sends his cheering you. Anyway, the relevance of dividend irrelevance. Let's go for it.
Irrelevant in explaining differences in expected returns. Building investment portfolios based on dividends results in lower expected returns when yield is in high demand, a lack of diversification, tax inefficiency, and an arbitrary retirement spending rule dictated by corporations.
Okay, a lot to handle. Let's restart. Sheesh. Let's restart. So the introduction is pretty cynical against dividends. So he said that let's listen and then I'll comment.
Dividends are irrelevant in explaining differences in expected returns. Building investment portfolios based on dividends results in lower expected returns when yield is in high demand.
This part is pretty interesting. Lower expected demand when yield is in a high demand. I never thought about that. So it says that when people are chasing a yield, so when people want to get stocks that returns a percentage of their investment and a consistent percentage of the investment, so stock prices will go up because the yield that those companies are issuing should be compared mentally to other yield you can find in the investment spectrum, which is like bond. So I never thought about that. Not sure it works this way, but I never thought about that. And everybody's chasing yield right now. So bonds are returning not very, they don't have an amazing return, so yeah.
A lack of diversification, tax inefficiency, and an arbitrary retirement spending rule dictated by corporations.
Okay, so arbitrary spending rule, because those who live off dividend, they live off what corporation decided to share with their shareholders, and not based on what it's their spending strategy. But you can always sell a bit, like a portion of stocks, or you can even reinvest part of dividend. So you can avoid letting corporation decide how much you want to spend if you still see your portfolio as under a total return approach, which is what you should do. Tax inefficiency, clear in many countries, not every country. And the other point was tax inefficiency, this thing, lack of diversification. Partially. Yes, for those who are asking, this reaction will be in English, but then I'll switch back to Italian.
Basing investment or consumption decisions on dividends does not make sense. I'm Ben Felix, portfolio manager at PWL Capital, and I'm going to tell you why dividend irrelevance is relevant to good financial decisions. Dividend irrelevance was...
What? Oh, there is a change in the intro.
Good financial decisions.
This is new, and that's amazing. Wait, what's in the background?
Relevance is relevant to good financial decisions.
Mutual fund. I can see luck versus skill. That's amazing. That's amazing.
Dividend irrelevance was shown theoretically by Miller and Modigliani in 1961. Fama and French showed empirically in their 1993 paper, Common Risk Factors in the Returns on Stocks and Bonds, that portfolios formed based on their dividend yield have 3-factor alphas that are statistically indistinguishable from zero. This means that after controlling for sensitivity to market risk, company size, and relative price, dividends do not contain any additional information about expected.
So, high dividend yield, doesn't add anything to eventually relative price, which is the value factor. They usually go related though.
Returns. I updated these data using the more recent 5-factor asset pricing model from Fama and French, which includes profitability and investment. For the full histories of an international developed high dividend index and a US high dividend index, I again find alphas statistically indistinguishable from zero. In other words, sensitivity to market beta, company size, relative price, profitability, and investment explain 100% of the returns of a portfolio formed on dividends. Stated another way, dividends contain no information about expected returns that is not already captured in the 5-factor asset pricing.
Sure. That's okay. Yeah, I agree with that.
Model. This is exactly what valuation theory predicts. The dividend discount model says that the theoretical value of a share of stock is the discounted value of expected dividends per share. But with dividend policy irrelevance, the value of a firm is based on expected earnings minus expected investment. This is...
Yes, okay, so if companies, doing discounted cash flow for companies that never issue dividends, it's complicated. I thought about that. Google never issued any dividend, so never returned money to shareholders. Shareholders are just selling shares among them, and just because holding a share of Google or Alphabet means you own a portion of the company, so a portion of all the assets, but you will never receive any money for holding on it. Which means if Google tomorrow fails, like go broke, nobody will ever like get any penny from having ever held on Google stocks. While if tomorrow Coca-Cola goes broke, over the course of 100, I don't know how many years, the amount of money distributed crossed many times even the current valuation, which is something. Your bar can shut down, but if it has been open for 30 years, it already returned like a lot of money to you. If your growth company is growing, never issue dividend, growing, then boom, finished. That has essentially been just a Ponzi scheme. So, growth stocks on their own, they're Ponzi scheme until they're proven that they are returning some money. Okay, I'm exaggerating.
This is the theoretical basis for the factors in the 5-factor asset pricing model. This is relevant because while portfolios formed on things like dividend yield or dividend growth may have exposure to low-priced stocks with robust profitability.
That's good. Let's listen it back.
Dividend growth may have exposure to low-priced stocks with robust profitability, which...
So it's actually correlating like dividend stocks. They might have exposure to 2 factors actually. One is low price, so value, and one is high profitability, so which is another one of the 5 factors. So both value and profitability, which makes sense. A company that distributes earnings, they have earnings. Their price to earning ratio is positive. I mean, it's not negative because they are losing money. So that's good. That's what I'm actually doing that's what I'm chasing after when I buy dividend stocks. I don't buy dividend stocks, I buy dividend ETFs, like a lot of them.
Which is a good thing. Dividends are just a noisy and inefficient way of getting there. To understand why, we need to start by understanding dividend investors. At the core of the theory of dividend irrelevance is fungibility. Investors should treat money equally regardless of its source. Yeah. However, dividend investors do not view dividends and capital gains as fungible. In that sense, dividends are relevant, but not in the way that dividend investors would hope. In the 2019 paper, The Dividend Disconnect, Hartzmark and Solomon find that investors...
I would love to read this paper, actually. So the thing is that exposure to factors is what matters. Having high dividend is an inefficient way to get exposure to factors.
View dividends as free money and account for them separately from capital gains. They call this the free dividends fallacy. The effect makes a stock that pays a dividend seem more attractive than one that doesn't. Hartzmark and Solomon find that dividend investors are willing to pay a premium for dividend cash flows above and beyond what a rational investor would. They find that dividend demand is higher when interest rates are low, and this effect is more pronounced for stocks whose dividends are more...
Okay, this is new for me. So the dividend stocks premium, like when you buy dividend stocks, high dividend stocks, you pay more just because they are issuing a cash flow. That is irrational. I mean, if 2 companies, they have the exact same business, but one issues high dividend and one doesn't, there shouldn't be like a huge difference in market capitalization. But what Ben is saying is that those who issue like a stable cash flow, their stock price, for some reason, because dividend investors want to chase that yield, the price is going up, which makes also the yield go down. So high dividend stocks returning 5%, no, it goes to 3% because the price will increase too much. So
cash flows above and beyond what a rational investor would. They find that dividend demand is higher when interest rates are low, and this effect is more pronounced for stocks whose dividends are more stable or have increased in the recent past.
So wait, that means that if interest rates are going up, dividend stocks should suffer from that. That's not happening, actually. Actually, that's not happening. My VYM and VYMI ETFs, they're doing great compared to VT, for example, even though interest rates are going up.
They estimate that investors buying dividend-paying stocks during times of high demand for yield reduce their expected returns by roughly 2 to 4% per year. In other words, when dividends are in high demand, like when interest rates are low, there is a good chance that dividend investors are overpaying for their dividend cash flows. Additionally, investors forming their...
As I said, okay, maybe I'm interrupting too much. As I said, that makes sense. It's not happening right now. For what I'm experimenting, that's not happening right now. Dividend stocks, or at least my ETFs, which are high dividend stocks, they are holding up way better than the global market. So that's not happening right now, but in theory it makes sense that when interest rates are low, people are willing to pay more for the stocks who offer like a stable cash flow.
Are overpaying for their dividend cash flows. Additionally, investors forming their portfolios on dividends end up with a built-in mechanism for under-diversification by nature of the fact that a huge portion of stocks don't pay dividends. In the US at the end of 2021, only about 38% of stocks paid dividends.
What?
Dividend labels like high...
What? Okay. So the point of diversification, of course, if you only invest in stocks in companies who distribute dividends, high dividends, you are missing out on companies who don't. And yeah, but there's still a lot of diversification. You're not buying individual stocks. I'm buying ETFs with thousands of components. So that's not that bad. Yes, you are missing on Google, on Tesla. That may be they're not the best performer of the next 10 years, but you are missing on, you are not fully diversified in the entire market. You are still diversified a lot. But what surprised me is that only which percentage of US stocks? 30?
Only about 38% of stocks paid dividends. Dividend labels like high dividend or dividend growth also obscure the underlying characteristics that investors are getting exposure to. ETFs representing common dividend strategies like dividend growth typically underweight smaller companies. That's not good. In the 2020
underweight smaller companies. But they're still market cap based. Yeah.
papers settling the size matter, Blitz and Hanauer find that risk premiums like value and profitability tend to be larger among small cap stocks. To the extent that a dividend...
Well, that could be fixed if somebody creates an ETF of small cap value or dividend stocks, which exists, VBR, and I invest on it.
Focus results in a tilt away from smaller companies, dividend investors may be missing out on expected returns. To be fair, it is possible to invest in small cap dividend growth stocks, but the reduction in diversification by requiring dividends is even more impactful in small caps. Despite higher expected returns in aggregate, individual small cap stocks display more return skewness and a higher frequency of underperformance than large.
Of course, the small caps, either you buy an ETF that covers all of them, or the small cap dividend stocks, 90% of them is gonna fail, but some is gonna return 100x, so that small skewness, like there is a distribution of returns more like far from the mean.
Larger stocks. Small cap dividend growth funds also tend to have higher fees and higher turnover, while not delivering anything special in terms of expected returns that could not be obtained through more diversified, lower cost, and lower turnover small cap value funds.
Okay, I was going to say the same. So, but I mean, even in their portfolio templates, there is small cap value. A small cap dividend, and small cap value, I assume there's a lot of overlap. I have VBR, which is a small cap value US ETF. It's doing pretty good.
Funds. Dividend-focused portfolios also tend to concentrate on specific industries. Some industries tend to have higher yields, others have more attractive dividend growth, and so on. So different dividend strategies will deliver different industry tilts. This matters because sector bets are not compensated in pursuing the expected value and profitability premiums.
Perfectly said. So essentially, investing in dividend stocks, you are shorting the Nasdaq. You're buying the entire market and then you're shorting the Nasdaq. Almost.
Which are really what dividend investors are seeking exposure to, whether they realize it or not. Realistically, a little bit of industry over and underweighting is inevitable in pursuit of value and profitability, but allowing dividends, which are not related to expected returns, to dictate industry tilts introduces completely unnecessary uncompensated risk.
Perfectly said.
Adding to the diversification problem for dividend investing, domestic dividends are often more favorable from a tax perspective, making global diversification much more expensive for a dividend investor. Finally, from a financial planning perspective, dividend investors' consumption is highly sensitive to dividends.
That's irrelevant because, as I said, you should not base your consumption on dividends. Like, it's not your income, even though in my spreadsheet it is part of my income. But if your spending needs are above what your portfolio can generate, you should sell part of your stocks. Or if you're spending, like, if your optimal spending point is below what your portfolio can give to you in forms of dividends, you should reinvest part of it. So it's a false. I don't like this part of the statement which says that people who follow a dividend investing strategy, they are essentially at the mercy of what companies issue as a dividend. Even though, okay, that's not necessary, but many dividend investors, if you go on their blog, on their YouTube, or on their channel, they actually claim to live off dividends. So somebody is actually doing this. So letting companies dictate their spending level.
In the 2020 paper, Stock Market Returns and Consumption, DiMaggio, Kermani, and Fallacy find in Swedish data that household consumption is significantly more responsive to dividend payouts across all parts of the wealth distribution, consistent with households treating capital gains and dividends as separate sources of income. In the 2022 paper, Consuming Dividends, Brauer, Hackathal, and Hanspel find in detailed daily data from a German bank that private consumption is excessively sensitive to dividend income.
Wow, I wasn't expecting that. Okay, that's a recent paper, Consuming Dividends. So household consumption strongly sensitive to dividend income. Okay, I never heard about that.
And that investors across wealth, income, and age distributions increase spending precisely around days of dividend receipt. Their results suggest that consumption response to receiving dividends reflect planned consumption driven by investors who buy dividend stocks intentionally, anticipate dividend income, and plan
which is completely stupid. If you buy a dividend stock before they issue dividends, you are essentially just paying taxes for free. Because the day they issue dividend, the stocks will drop and you pay taxes on the dividend. It's completely stupid to time dividend days. That's completely stupid. Yeah.
Consumption accordingly. This is a problem. Dividends are a rather arbitrary approach to determining the magnitude and timing of consumption. Total returns are harder to think about with respect to consumption because they aren't explicit cash flows. But this is easily resolved through financial planning. Defining a desirable consumption path, determining how much can be sustainably spent from a portfolio following that path, and then spending sustainably from the portfolio regardless of the source of returns. Spending dividends can be thought of as a variable spending strategy.
Yes, but still, I don't buy this part because, of course, many people would define their spending strategy based on dividends, but I don't. I don't care.
Rather than spending the same dollar amount, you spend whatever your dividends are. Variable spending is a good thing. It is more efficient than trying to spend the same dollar amount adjusted for inflation
better than
from
the
a portfolio
4%
each
rule.
year. More consumption variability allows...
I want to get this one because I think it's interesting. This article, Blanket Kowara. Let's see if it is here. No. This one, Blanket Kowara Chen Optimal Withdrawal Strategy. Okay, it's not here.
Retirees to consume more of their wealth while they are alive. This is known as consumption efficiency. Variable spending does not require dividends, though. One way to accomplish variable spending without relying on dividends is to spend some percentage of the portfolio each year, but only increase or decrease the prior year's dollar spending amount by a ceiling and a floor.
Okay, he already explained that in a critique to the 4% rule. And another amazing video on early retirement. That's an amazing video. Of course, the basic idea of the 4% rule is that you decide how much you want to spend on year 0 of your retirement and then increase by 4% or a fixed percentage each year that should compensate inflation, which sucks. It's pretty stupid. Variable spending strategies, there are many. Probably the one that oh, amazing, Marco. Thanks. Tack. Then I'll see later. Vanguard published a study a couple of years ago, roughly around Ben's video about the 4% rule and early retirement of variable spending strategy, which makes your spending for next year, I mean the amount you can withdraw from your portfolio on the next year, this one adjusted for inflation or a bit more or a bit less based on the market performance. So you try to spend more when the market is doing good and spend less when the market is not. So that's another strategy which is proven to be more efficient than just the 4% rule, and that's amazing. I don't know, he's explaining why people should plan for their spending in a variable way, but not variable based on how much dividends the companies issue, but on other factors, which is the total return of the market and your personal needs, and you should not. The conclusion of the dividend video, the previous one, was something like you should not let companies dictate your spending. Yeah.
For example, you start with 4% of a $1 million portfolio in year one, $40,000. In year two, the portfolio is only worth $800,000. But instead of cutting spending to $32,000, you only cut it to the maximum 5% year-to-year change, $38,000. The ceiling and floor on spending variability can be increased or decreased depending on your preferences. Less variability in consumption is less efficient, but for someone with a strong preference for stable consumption, inefficiency is just a trade-off. It's not necessarily a downside. The optimal spending strategy for each individual depends on their preferences,
that's what
which
we just
highlights
said.
one of the big problems with leaving consumption decisions to corporate dividend policies. The other problem here is that dividends are empirically inefficient relative to other variable spending strategies. To illustrate this, we used the top 30% highest dividend yield U.S. stocks from 1927 to March 2022 and modeled rolling 30-year withdrawal periods. We tested
It's Kenneth French data.
1,000 possible variable spending strategies with incrementally increasing spending flexibility and compared them with spending dividends. Given a level of total consumption, we found that spending dividends resulted in a lower ending net worth.
Okay. Consumption in thousands of millions. Not completely following this graph. Final net worth. Okay, I mean numbers are pretty like anyway, there is, I mean, the more you consume, the highest the final net worth, I mean the lowest the final net worth. But on this frontier, if you only spend dividends, you consume like this amount, but you are only left with a lower final portfolio value instead of this one. So that's what I understand.
Given a standard deviation of monthly consumption, we found that spending dividends resulted in a lower ending net worth. And given a standard deviation of monthly consumption, we found that spending dividends resulted in an approximately equivalent total consumption. Stated simply, given a financial planning objective, spending dividends is probably an inefficient way to achieve it.
And
finally, dividends are not an inflation hedge. In the US data, there's no strong evidence that dividend stocks...
Not even that? Let me try to anticipate. Let me try to anticipate where he's going. In my mind, if dividend stocks are connected to value stocks, and value stocks are like low price stocks compared to their fundamentals, like price to book value, price to earning value. Which companies have a low price to earning? Those who don't have much, probably like a lot of growth potential, or like they're not exponential companies. They're just companies which are in the business. So they are having earnings. They're pretty stable. And they usually produce goods. Companies who distribute dividends are companies who produce goods and services, whose price is going up if inflation, I mean, they define inflation. So how cannot be having dividend stocks and inflation hedge?
Have delivered improved inflation-adjusted performance during periods of high inflation or rising interest rates, and globally, real dividend growth over the last 120 years has been negative for about half of the countries that we have data for. Dividend policy is theoretically irrelevant to expected returns. Empirically, dividends do not explain differences in returns between diversified portfolios once company size, relative price, profitability, and investment are accounted for, as valuation theory predicts. In reality, investors really like dividends.
Okay, let's see how this, let's see until the conclusion, and then, of course, I mean, it's hard to disagree. It's a cold shower, predictable cold shower. There are 2 or 3 points that I want to re-listen and elaborate a bit. In general, he's totally right, of course.
Which can result in them overpaying for yield when yield is in high demand, driving down their expected returns. Focusing on dividends in portfolio construction, rather than on the drivers of expected returns, can result in an unnecessary reduction in diversification and an increase in tax drag. In addition to being inefficient for portfolio construction, dividends defer retirement consumption decisions to corporations rather than being tailored to the preferences of each individual.
And this part I disagree.
A financial planning objective like maximizing ending net worth, maximizing consumption, or minimizing the variability of consumption, spending dividends is typically an inefficient way of getting there.
On this I agree, but that doesn't mean that if you invest in dividend stocks, that's what you end up doing.
Dividend-paying stocks do often have some attractive characteristics, but those characteristics can be targeted directly without the completely unnecessary dividend filter.
That's the best part. If you want exposure to value stocks, you should go and buy value stocks.
Thanks for watching. I'm Ben Felix, Portfolio Manager at PWL Capital. If you enjoyed this video, please share it with someone who you think
I'm
could benefit from the
sharing
information.
it.
We also discussed this topic in more detail in episode 201 of the Rational Reminder
Yes,
podcast.
maybe I should watch that one as well. Okay, thank you, Ben, for your amazing video. As always, keep doing this kind of videos. I love them. Thank you for all you're doing, and good luck with your 4th child.